Hey, what's up, everybody? It's TJ with the New Standard and Strategic Real Estate Experts, and today we're going to talk about what are the different types of mortgage options out there available to you, and potentially what's the best one for you and your family. So there's some basic, like 6 to 7 basic programs, and then we'll talk a little bit more about their specific ones based on the area you are in the country, where you are specifically where we are, and kind of how you should look at that, and then go, okay, what's the best one for me and my family? If you've been following us, you probably have a pretty good idea of what the best one is, or some questions to ask to make sure you're getting the right one. But first, and one of the most popular ones, is called a fixed rate mortgage. So what it is there's a bunch of different terms with all of these, but it's traditionally a 30-year mortgage amortized over 30 years. So what the amortization is it's how long it will take you to pay it off. So a 30-year mortgage amortized over 30 years will take you 30 years to pay it off. So that is the traditional mortgage that people think about. It can be anywhere from as much as you want to put down to, again, it depends, but as little as 5% down to get a conventional fixed rate mortgage. One of the other ones we talk about is an ARM, or an adjustable rate mortgage. So that's where the rate actually adjusts. It totally depends on the lender and what type of ARM you do, but you could have a 1 year, a 2, a 5, a 7, maybe a 10 if a lender has that specifically to lock in the rate. But what it is if, let's say you have a 5-year ARM, you're going to lock in your rate for those first 5 years, and then it's going to adjust. So much like an adjustable rate mortgage, there's ones, that are two-step mortgages. So sometimes you might hear it called a 5-2-5. So what that is you're locking in the rate for 5 years, and then for the last 25 years, it kind of adjusts up and down. So first 5, then 25, so it's a total of 30 years, amortized over 30 years. So what happens is obviously if rates go up, you're going to pay more in interest rate. If you think they're going to go down, then obviously you would pay a little bit less. So very similar to the adjustable rate mortgage. Most people just say adjustable rate mortgage versus two-step, but that's one of the ones that is kind of big. Another one is called an FHA loan. A lot of first-time home buyers use this loan because it's great. You only have to put 3.5% down, little lower credit score to qualify for that. Again, my purpose is just to kind of get you guys educated on some of the stuff that's out there. Next, we have a VA loan. So if you're a veteran, this is awesome program. You can get away with no money down and no mortgage insurance. So for those of you that are just starting to follow what mortgage insurance is, it's either called PMI or MI for mortgage insurance, or PMI for primary mortgage insurance. And that is when you don't put 20% down on a property, the lender charges mortgage insurance to insure the property in case you default. So that is what that is for. The less you put down, the higher the mortgage insurance payment could potentially be. The more you put down and get close to that 20%, then the smaller that amount becomes. So for those of you that are veterans, totally awesome program. But we still have veterans that buy houses and they'll still put 20% down or 10%. But the cool thing is if you don't have that full amount of 20%, you could put no money down and have no mortgage insurance. So one of the other ones is called a balloon mortgage. So that is a mortgage that they call it a balloon because basically it's interest, or some are interest in principal, and usually after 5-10 years, the note, so the loan is called a note, is due and payable. So you might do a $200,000 balloon loan. Typically these are a lot higher loans, like $500,000 to $1 million loans. So let's say you do a $500,000 loan, you have interest, and then in year 5, now that whole loan is due. Or you go refinance and pay that one off and start a new one. So balloon loans typically don't go out through a long period of time. Now, those are going to be like I'm painting a broad brushstroke here. Like there's so many more programs in that. That's like the big overview, quick, here are some of the big programs that are out there for you as a buyer. In our own local area and wherever you are, depending on where that is in the country, almost every lender's office you walk into will have some type of specialty program that maybe they specialize in. I know lenders in our area that are specializing in new construction loans, some that specialize in people that are going to rehab houses. people that specialize in financing, but in buying investment properties. One of the banks here does a 15% down on investment property as one of their in-house loans. So typically, you're going to put 20 to 25% down, for example, on investment property. So investors around here like that bank because they can put less money down to get into the property. We work with some other local lenders here. Some of the big programs where we have WHEDA, Wisconsin Housing Economic Development. They do a loan that's a low money down loan for first-time buyers where we are. We have a rural housing loan in our area. We have a bunch of down payment assistance programs. But really what we're going to try to get across here today is that you have options as a buyer. So if you're just going in to meet with a lender and they say, hey, here's the loan that's good for you. One, you probably have more than one option. And two, they need to explain to you what the different options are. And then based on what those options are, there's different things you can do. Because you might do a fixed rate loan and think, you know what, we only have 10% to put down. We're going to put the full 10% down to get the mortgage insurance as low as possible. But if you sit down with us and we go, hey, I know you have 10% to put down on this $300,000 house, which would be $30,000. But instead of putting the $30,000 down, let's put 5% down. So we're going to put $15,000 down. So you still have 15 over here. And because you're telling me this is a forever home or a 10 to 20 year home, what we'll do is we'll buy that mortgage insurance down up front for, I'm not going to say the specific amount, but for a few $1,000s. So let's say in this case, it's $5,000. So now we've spent $20,000, but we wiped out the mortgage insurance versus putting our full $30,000 down and still having that mortgage insurance. And what you have to do is basically look back and track backwards to what the best option is for you. This is totally confusing. Like, I can confuse a lot of new agents when we talk about some of this stuff too. But that's why we have people come in to meet with us so that we can look at your specific situation. Other people will have come in and they'll go, you know what, we're doing a residency here at the hospital, 4 years max. So maybe we look at a 5-year ARM because you're going to get a little bit lower rate. And if we can get that lower rate, why do you need to lock in a rate for 30 years? You don't need to do that. So you have to understand your own specific situation, how much money you're going to put down, how long you're going to stay in the property, what type of loan program is the best for you and your family. So again, you can't just, even if you meet with somebody and they're like, oh, go talk to this lender, they're great. We have lenders here that are absolutely fantastic, but they might not be the right lender based on what you need because they don't offer that program, right? So if you're an investor, I'm going to send you to the lender that does investment property and knows how to do those loans and is going to rock it for you. Or if you're a first-time home buyer that needs down payment assistance, we're going to work with a lender that understands the down payment assistance programs so that we get you the house that you want and it doesn't fall apart in the end. So again, if you have questions about some of this stuff, I know it's super confusing and I was throwing out all these different terms and like, go back and listen to it again. But check out knowbeforeyouBuyRealEstate.com. We have tons of free stuff on there. You can set up free consultations with me, but you can always reach out to me. Call, text, email 608-576-0044. Email's TJ@sreehelp.com. Don't forget to raise your standard, and we'll talk to you soon.